Gold had an important technical development last week, breaking out of the trading range that's been in place since early February and closing close to $1,300 an ounce. My soft target for gold from here is about $1,400 an ounce because gold made a measured move of about $175 an ounce off of the bear market low around 1050 all the way to 1225. And if you take that move again from 1225, that measures to about 1400. And as well, gold experienced resistance at 1400 in early February and again in late 2013. So that's a logical area for gold to experience resistance again before it can continue higher. Now, one of the main problems with the gold mining stocks and why I've titled this video Gold Sell in May and Go Away is that a lot of these mining stocks are extremely stretched above their 30-week moving average. If you go to my stage analysis screener, you can see on the percent for moving average column that many of these stocks are more than 100% above the moving average, which is extremely extended and a dangerous time to be entering new long positions. Now, looking at like the history of GDX, you can see that GDX is more extended now above its 30-week moving average than it's ever been, um, at over 40% right now above the 30-week moving average. GDXJ is the same way. Even during the blow off top in 2010, GDX is further above the moving average now than it was back then. Um, the historical example of the Huey is actually pretty good because this shows the bear market bottom in the year 2000, which is probably the closest analog to the bear market that we've just experienced because this was a long and grinding down bear market, which is unlike the panic bear market that was experienced in 2008. So you can see that off of the 2000 bear market bottom, the Huey went up to about 40% above the 30-week moving average before consolidating for about 6 months. And then it broke out again in early 2002 and went to probably about 50% above the moving average before consolidating for almost a year before it broke out again. So it shows that when the mining stocks are this stretched above their long-term moving averages, usually they go back into a consolidation mode where they have to let the long-term moving average catch up before they can assert a new up leg higher. And this is because the buying and selling goes back into equilibrium after such an extended move where profit takers come in and short sellers come in and make the market more balanced, and this is why it can't continue moving higher. So there's always a point to where these parabolic moves stop, and even though the bull market can continue, you can have a long period between another up leg. So you have to watch out that you don't get caught in these trading ranges and your capital becomes kind of stale while this goes on. Now, one reason that I'm still kind of bullish on gold for the month of May is that gold really isn't that extended compared to where the mining stocks are. You can see on this chart of gold that back in 2006, for example, gold got to about 25% above its 30-week moving average, and in mid 2006 when that happened, it took about a year for gold to make another new high. So that's another example of an extremely stretched market taking a while to reassert the bull market. Of course, in 2011, when gold made a major high, that was the bull market top, and then the new cyclical bear market. So that's an example of again, the market being too stretched and reversion to the mean. Um, Similar thing happened in 2008 where we got about looks like almost 20% above the 30-week moving average, and then gold went into the 2008 bear market, but took a while overall to make another new high. So if we see gold continue this breakout and get to maybe 15 to 20% above its 30-week moving average over the next month or two, that would put gold in the same category where it'd be more likely that gold would need to consolidate for a number of months before reasserting the bull market higher. Now, looking at some of these mining stocks, First Majestic Silver, even during the super spike in 2010, where it went from about 4 to 27 over a period of about 6 or 7 months, it still didn't get as overbought as it is right now compared to the 30-week moving average. It got up to about 80% during this spike, and then again on the super spike, but still wasn't as high as it is now. Great Panther Silver has been going almost to the moon parabolic right now. It's almost 150% or over 150% above its 30-week moving average, and this is even higher once again than it was during the super spike of silver in 2010 to 2011. Same thing with Yamana Gold, even though Yamana got obliterated during the 2008 bear market, it still didn't really experience as big of a move as it has off of this bear market bottom in 2016. And it's gone, extremely higher in a short period of time. Now, another reason why these mining stocks and precious metals are potentially in for a multi-month consolidation is seasonally, gold experiences its third best rally in the April to May period, but usually towards the end of May, gold um, completes a seasonal top, and then doesn't really make another new high until sometime in August. And usually they call it the summer doldrums, but you'll see June, July, and the first half of August be kind of a period where the precious metals don't do a whole lot because the buying season in the East is typically towards the end of the year and then early in the new year. So overall, if you're um, a little annoyed or you missed the major rally we've seen in the gold stock so far this year, you can take a look at my stage analysis buying process page. But the bottom line is that there's 2 points that you really want to be buying any stock or ETF is if you're using stage analysis. It's the ideal buy point A and B, which is the break above the 30-week moving average on a massive increase in volume, or if you get this sometimes doesn't happen, but if you get the pullback to the 30-week moving average, that's also a low risk buy point in a new major bull market to get positioned in. And those are shown graphically down here, where you get the breakout out of the stage 1 base, and then if you get the retest of the stage 1 base and then the new blast off higher, that's another good place to buy. But if you notice what's going on with the mining stocks right now, we're way past that ideal buy point now, which occurred back in February. So if you're trying to chase the market now, you're entering in a much more dangerous spot. And of course, the bull market could go on for a number of years. So overall, this still could be a good buy point for the long-term bull market, but you might have to wait 6 months to a year, depending on how long the next consolidation is before the next major up leg, if you buy into these super spike rallies. So, and which is a easy thing to say, but is a hard thing to do if you actually do enter in too late and watch your position lose 20 to 30% of its value in a correction before it moves higher again. So that's why I view this current period in the precious metals as a time to maybe look for a multi-month consolidation after this amazing rally that we've seen, and prepare to kind of hunker down. And I'll probably talk about that more in some upcoming videos. But you can also go back and look at some of my previous videos about the ideal buy point for gold when we talk about where we wanted to be during that February breakout. And that's always, it doesn't matter what asset class you're buying, but you always want to buy whatever is breaking out of this ideal buy point is what you want to be looking for.